Hey guys, in this video I'll talk about what is market capitalization. It is also called as market cap. In the textbook terms, it is market capitalization is the total market value of publicly traded companies' outstanding shares. So what do we mean by outstanding share? An outstanding shares is the total share which has been issued by the company, and currently it could be held by promoters, founders, FII, DII and investors. After all these holdings, then the remaining shares which will be there is available for trading to public, retails. So considering all these quantities, it is called as outstanding shares. All the shares which is available for that company. The formula is used for calculating is market capitalization is equal to share price into total outstanding shares. So even if you search in the Google outstanding shares for X company, you will get the outstanding shares of that. With that, you can able to multiply with current share price. You will be getting the market value. If you take example, if Reliance is trading at 2,800 and its outstanding shares is 676 crores. If you multiply both, we will be getting 18.9 lakh crore. That is the total market value of this company, market cap. Why do we have to calculate the market cap in the first place? Because without understanding the size of the company, we cannot able to compare it with other companies. If you take example of automobile, we have Tata Motors and we have Mahindra. If we know the market cap of these two companies, so that we can able to get an idea of how big or small the company is compared to others. It could be also the reason where we'll be comparing with smaller companies. We could be comparing Hero MotoCorp with the new company which has been started, Ather. Hero MotoCorp is a very big company compared to Ather. How do we get to know whether it is good big company or small company? Based on its market cap. This is where market cap is used. There is also a categories in market cap. Mainly it is divided by three categories, but there is also fourth category. One is large cap, where all the big companies which has been well established and it is doing business for over years. It could be doing from 2000s, 1900s. All those old companies and big companies will be coming in large cap. Next comes mid cap. This company is smaller than large cap, but these companies are there in business for around 15-20 years, something like that. These companies would have not reached their peak or the highest sales possible for them. If you take example of Colgate, majority of the people are already using Colgate. For the Colgate to improve its sales or profits, either they have to increase the number of users. Number of users cannot be increased because the population growth is stagnant or will be growing in a fixed growth rate. Based on that, the Colgate can be considered as the large cap because it has already reached its peak. But when we take example of mid cap, it has made a base of that business, but it has not yet grown at full pace. Then comes small cap. It is smaller compared to large and mid cap. These companies would have been started out few years ago, between 5 to 10 years. And these companies are very small. They have not seen the problems or all the economic crisis. These are all new companies. These companies have potential to grow. There is also risk of these companies or these businesses may not work out, because of which this becomes a risky investments. Large cap becomes safe investment. Mid and small cap becomes a risky investment compared to large cap. But when the person who wants growth, he'll be choosing mid and small cap stocks. Then final category is micro cap. These companies are very small compared to all three. They might be less than 100 to 50 crores market cap. And the probability of these companies becoming a large cap or mid cap is very small. And the probability of these businesses not working out is very high. Because of this becomes very risky investment. Then comes what is the difference between market cap and company value. The market cap doesn't shows the company's real value. It only shows equity shares value. We want to know company's value. We would have to analyze its assets, whatever the land it has, buildings, machineries, and any patent it has. All those things is an asset for the company. Then we have to look out for liabilities. Does the company have any loans, or the company is going into court cases? If the company loses that court case, then they may have to give a huge number of money to the opposite person. That could be also the liability. then the cash the company has. All those things comes under company's value, and these things are not included in market cap while calculating the market cap. So market cap and company's value is two completely different things. Then there is also another word called free float market cap. Free float refers to the shares which is actually available for trading after not considering the promoters, FII, DII and any investors, because these people won't be selling the shares or do the regular trading. Because of this, whichever the shares they are holding is currently of no use. Only the available for trading is the real volume or real liquidity. Free float is calculated multiplying share price with publicly tradable stocks or publicly available shares. If we take a difference between total outstanding shares and free float shares, in total outstanding shares, all shares issued by the company is being calculated, and in free float, only the publicly available shares is being calculated for valuing. In outstanding shares, promoter holdings is considered, and in free float it is not considered. In outstanding, government securities is considered, and in free float may consider, may not be considered. And these two are used for outstanding shares. It has been used for calculating market capitalization, and free float is used for index calculation. And into outstanding shares, liquidity is very less accurate, because if promoters, FII and government wants to sell the shares, and if they start placing the sell orders in the market, at that point of time all the share price will be falling drastically. Because of this, the accuracy of valuing the real thing is very low. The promoters may not be able to sell their shares at current market price, because if they start selling the shares, because they'll be holding in a huge number of quantity, and because of this supply and demand will be changing. This will result in share price fall. While calculating free float, it is more accurate, because the calculation is done based on the available currently tradable shares. What shares are excluded while calculating free float? Promoter holding is not considered, government holding is not considered, shares held by founders is not considered, logged in shares by any FII, DII or any banks, that is also not considered, employee welfare fund, ESOPs, those things are not considered, cross holding between companies is also not considered. Sometimes what happens, usually people call Tata groups. The reason people call it groups is because one is the companies is from the same founders or with the same name. Second thing is because one company will be holding a part of the shares of other companies. That is the reason it is called as groups. So if one company wants any help, the other company can be willing to help. What is included in free float? FII is included, DII included. FII comes foreign investment funds, DII comes mutual funds, banks and local investment funds. Then mutual fund comes under DII, retail is included, HNI clients are included, insurance companies investments is also considered. Insurance companies main business or main profit is not from premiums. Their main profit is from the investments which they make with the premium amount. The main reason of including this all is because FI usually they do buy and sell, DI also, retail they usually buy and sell, HNI also will be run through certain PMS. I'll come to PMS in a separate video. HNI clients also usually do regularly buying and selling, and insurance companies may have to do buying and selling at certain point of time. When there is a lot of claims, at that time they have to withdraw their investments. So that's it for today. Thank you very much. Have a great day.